When we talk about the metals, gold often steals all the headlines. But our guest today says there's another metal that's even more interesting in this environment. Joining us now to discuss is Daniel Galley, Senior Commodity Strategist with TD Securities. Daniel, great to have you back on the program.
Yeah, thanks for having me, Greg.
You've been doing some interesting work recently, publishing some really interesting notes on what is happening in the silver market. Walk us through it.
Sure. So I think this is the biggest story in the commodities complex today. What we're really seeing is evidence that silver markets are sleepwalking into a potential squeeze. Right? The silver story is one that's been building for a long time. Right? This is a story about a structural deficit that for the foreseeable future will not be solved. It's the intersection of the commodity supercycle themes that you've often heard about in the context of copper, but we're now transitioning away from a demand boom that we have seen over the last 4 years and towards a different story that we can get into. But ultimately, this is a function of epic demand growth in the last several years and of a supply function that's been constrained by years of underinvestment in metals and mining. This is all now coming to a climax in silver markets, we think, in 2025.
All right, so sleepwalking into what could be considered a Pandora's box opening situation. How did you've laid out the mechanics of what's happening here? How does it start to play out this year?
So with respect to Pandora's box being open, right? Really, the point we're trying to make here is that actually, in contrast to a lot of the other analysts on the street, we actually think that demand growth is set to slow down in silver from this moment forward. And the reason we think that is, firstly, solar, which has been contributing to the overwhelming majority of the increase in demand that we've seen over the last few years, is set to slow down. That's a function of the political pendulum swinging, but really it's mostly a function of the fact that solar is now a big industry and there's overcapacity in terms of solar production in China. That overcapacity has actually led Chinese solar fabricators to innovate and to change their technologies. And the new technologies now consume less silver per solar cell. So this is a demand story that is one that is going to slow going forward, but the fact of the matter is the cat's already out of the box. The gap between supply and demand has been built over the last several years, and a slowdown in demand isn't going to resolve that. What you would actually need is demand destruction, outright negative demand, for the market to find balance again. And that leads us to the question of, if we are in a structural deficit, and even if demand is slowing, what's going to solve it? Where are we going to find the metal to satisfy these new sources of demand for silver? And ultimately, it's going to have to drain inventories, right? And here's the basic assumption that people have had for the last 20 or 30 years in silver markets, is that you can never run out of silver. Right? The thinking behind that is that every ounce of silver that has ever been mined in human history is sitting above the ground in some form somewhere in the world. So you can actually never run out of it. And if you look at visible inventories, right, there's still 1.2 billion ounces of silver sitting visibly in the various exchanges across the world. Right? In the context of a deficit that might be 150 million ounces, it's no wonder that people aren't concerned about it. But what if I told you that only a fraction of those inventories were actually freely available for purchase? Right? In our estimates, in the largest vaulting system in the world, there's really probably only 305 million ounces available for purchase as of December. And we actually think that there's been some catalysts that are going to drain the vault substantially faster than we had initially expected.
All right, let's get into some other potential catalysts as well. You talked about the market setup here, the structural deficit. Of course, Donald Trump will be inaugurated on Monday. He has been threatening tariffs. How does that threat play into the situation?
Yeah. Well, that's precisely what we think has catalyzed the drain in the world's largest vaulting system. See, most of the precious metals industry, the physical commodity traders out there, they tend to hold their physical metal in the London bullion vaults, and they tend to hedge the price risk using COMEX futures, which are US-based futures contracts. The issue that's been arising over the last months is that the threat of tariffs inhibits the kind of arbitrages that people rely on to move metal from one location to another. And the implication here is that in order to hedge against the risk of tariffs inhibiting their arbitrages. They're moving metal into the U.S. now, trying to get it in ahead of Inauguration Day, such that they're not left empty-handed if tariffs are actually applied. So this is really the big catalyst that is currently draining metal at a very fast pace out of London. And it begs the question, will London vaults drain sufficiently to challenge the market structure, to catalyze what some can describe as a squeeze on physical silver markets? And so currently we actually think there's a tidal wave of metal that's already on its way into the US. That's true for gold, it's true for silver and other precious metals and copper as well. And really all it reflects is traders trying to hedge this tariff risk. But the implications are unique for silver because of the structural deficits and the fact that inventories have been draining for several years.
Right, so lots of pressure building up. Are there any pressure release valves out there for what you're saying, the squeeze?
Yeah, and I think it's a valid argument that over the long term, you're not going to run out of silver. There is a huge amount of above ground inventories, but the issue I have with that is that they're not necessarily available at current prices. Right, so if you think about the very large stockpile that might be included in private vaults across the world, that's one potential avenue of inventories that we can drain in order to satisfy the demand-supply imbalances until a moment of time where the fundamentals correct, so where you might see demand destruction or new sources of supply that open up. The issue is that over the last year, we've had a pretty substantial rally in silver prices, and there's absolutely no evidence of private vaults being tapped to satisfy the deficit. So really what that tells you is that we haven't reached the strike price necessary for these unconventional sources of supply to be tapped. And ultimately, that leads us to the conclusion that we're currently in a price discovery process, which is a strong argument for owning silver.
All right, fascinating dynamics there in the silver space. Thanks for walking us through those. Got to ask you about gold, though, before we end our conversation. You and I and Bart Melek, your colleague, have talked many times over the last year or so about the mystery buyer coming in and out of the market. Apparently, the mystery buyer has returned for gold?
We think that there are definite signs that the mystery buyer may have returned. Right, and really, we've spoken about this at length over the last year. I think there's tons of stories out there on gold. There's a lot of misinformation. In our view, gold's story over the last year, what led to it having an exceptional year in terms of price performance was an initial disconnect in money manager positioning relative to the Fed outlook at the time. The rates markets were anticipating, as of January, 7 or 8 cuts for 2024, and macro funds that invest in gold on that premise were basically underpositioned. Their position was stale and still reflecting a higher for longer world. So the disconnect resolved itself, and that led gold prices about 10% higher from the start of the year. Beyond that, it was really a story of very aggressive physical market buying activity. There's tons of information about the de-dollarization narrative that has led central banks to do that. But it doesn't necessarily explain the pace and magnitude of those purchases. And what we've found is a pretty striking relationship or correlation between the scale of that buying activity from what we might call mysterious to Asian currency depreciation pressures. And we're finally at that point where currency depreciation pressures in Asia are acute enough to lead us to think that the mystery buyer may be returning. We're also seeing some evidence that gold prices are outperforming relative to their traditional indicators that you might watch, the US dollar, US yields, and so on and so forth, which is another sign that there is something else happening in gold markets that isn't related to what you typically look at and might be related to the mystery buyer returning to gold.
Can we go as far to call the mystery buyer China or China's central bank, or is it not that specific?
You know, we use the term mystery buyer because it attracts attention. It's a useful way to describe what is otherwise odd buying activity in gold. But the fact of the matter is it's probably several participants with similar incentives participating in gold markets at the same time. There's certainly some evidence of buying activity from the Chinese central bank, but there's also evidence that Chinese retail participants, Japanese retail participants, institutional investors across all of Asia played a significant role in that story last year as well.